Hello friends. Today we'll discuss about the charts of Bank Nifty for the next week. Let me analyze the daily chart first. The Bank Nifty chart does look promising. The 20-day moving average is at 29,552 and it is holding well above the 20-day moving average. And here's the number of red bars are increasing, but looks like it could retrace to 38%. If we look at the big swing, the 38%, the 61% retracement comes to 26,880. So yes, that could be a good support, but I don't feel it will come down so quickly. And if we look at the second swing, then the 61% is at 28,000 exactly. So yes, 28,000 levels will hold on in the near term, and that would certainly be a good level to buy. I'll tell you one very important thing. All the good levels to buy are where the rally started. So this is the area where the rally started. If at all it comes here around these levels, I know it won't come so early. But yes, it could come anytime in the future as well. This could be the best levels to buy 25,000, 26,000. Okay. What I'm saying is you can buy ETFs, you can buy exchange traded funds for banks and just accumulate in this area. I know it is not easy to buy futures. If you buy futures here, it could go down and then it could come up. Okay. So what I'm saying is you could accumulate good banking stocks like Kotak Bank, Axis Bank, and ICICI Bank and other good banks in this zone. I know it won't come here, but whenever it comes, it would be a great opportunity. Okay, you should be ready for it. This area won't give you a good risk reward ratio. From here, it could go to 33,000, but if it comes here and if it goes up, you will get a reward of 5,000 points. From here to go to 33,000 is a bit difficult. Okay, but from here, if at all it comes here, from here to go to 30,000 is quite possible. So you should look at good risk reward ratio trades. Yes, the market could go up from here. I'm not denying that, but always look out for good risk reward trades. That's what will help you in the future. Okay, so my favorite tool, Fibonacci retracement, does say that the support could come in at 26,000, but those levels are unlikely for the next week. So we'll see one more swing from there. If you see the swing from year to year, the 61% is around 29,500. So the first support for the market would be around 29,500 if it has to fall down. Yes, it could go higher, it could go to higher levels, and it could touch approx. It could touch the previous highs. It could touch the previous highs of 32,000 approx. So we'll draw a line over here. What is the previous high? Okay. So these levels. So there is a space for market to go up. Okay. Even though there are resistances around 32,000. This resistance has already been crossed. No, this resistance is also yet to be crossed. So 31,000 and 31,000 does remain a resistance for the market, and supports coming at 29,000. Okay, the previous resistance does act as support. That is the concept of the markets. That is the concept of how the prices work. Okay, uh, that is the concept how the prices work. This big candle, if at all comes in this zone, it is a very good opportunity to buy this big candle. I know it's a big candle and difficult to capture, but you can accumulate in these zones. Okay, that's what my only point is. All these gaps are now filled, so they are not relevant anymore. But there is a gap over here which is created, so 27,000 it will certainly come in the future. When you never know, but yes, there is a probability of it coming near 27,000 again, retesting those levels and again going up. Okay, if you check, all the gaps created in the market get filled one day or the other. So yes, look out for those possibilities as well. Fibonacci retracement on the weekly charts would suggest the same thing. 25,400 is a 61% deviation. This is the entire rally. If you look at multiple legs, it will certainly be a different picture. But Fibonacci retracement we have already considered on the daily chart, and over here, if we check, the Fibonacci is 27,000. So yes, and the 20-day moving average is 24,600. So yes, the market could go sideways. Okay. Okay, if you see, the market cannot stay away from the 20-day moving average for a long time. If you see, the distance of the price from the 20-day moving average is quite large. Now, how to measure the distance? You can see from the chart, man. You can see from the chart. If you see over here, the 20-day moving average, when the price reach here, would be approx this. Okay, so yes, it can stay away from the 20-day moving average for a bit long, but it has to catch up with it. So yes, the pace of going up will certainly look slow, and it won't go as fast as it has gone here to upside. Okay, the upside pace, it could go upside, but the pace which we have experienced in the recent days could be missing in the market if it has to go up. Okay, as per the times, see now the December month is approaching, and this December months are usually thin in volumes as the FIs go on a leave during the Christmas holiday and the 31st New Year. They celebrate the New Year. Okay, the market is suddenly at a resistance on a weekly chart. So yes, 31,000 once it is crossed, it could show some momentum towards 31,500, but it has to close decisively. It has to close over above it, and it has to open good enough again on the next day, so it will be a good move. Okay, so we'll keep on analyzing the charts. I'll update you as soon as I get some other update. Okay, thank you.